Question 3 says that the cost accountant of ABC Limited has provided the following information relating to production of a single product branded Z. We have production, sales, opening stock, closing stock. Additional information is that the financial details for one unit of product Z, based on a normal activity level of 30,000. I think that should be 30,000, not 30.0. Should be 30,000 kilos, is as follows. So we are given that the selling price is 9. Administrative overheads are fixed at 25,000 per period, whereas 1/3 of production overheads are fixed. So you are told to prepare operating statement using variable costing and absorption costing. So I told you, when you come across these questions, the very first thing is to get the unit cost. The very first thing is to get the unit costs. Is to get the unit cost. And in getting the unit cost, we start with marginal. And marginal captures the variable components. It captures the variable components. The variable components here are, you can see there is direct material, which is 1.5. There is direct labor, which is 1 bob. And then we are told production overheads, they are 300% of labor. And the question says in information 3 that administration overheads are fixed at 25,000 per period, whereas 1/3 of production overheads are fixed. So we are going to add 2/3 of these 3 bob. So tell me, what is the answer? What is the answer for that? What is the answer? $4.5. So even is 4.5, let's now get what we call fixed overhead absorption rate. So fixed overhead absorption rate is 1/3. Is 1/3 of 3. So that would be 1. Is 1/3 of 3, that will be 1. The fixed overhead absorption rate. Then, toka hapo, after we have gotten that, we are supposed to get the absorption. Absorption, tulisema it is the variable, this one, 4.5. You add the fixed. So that will be 5.5. That will be 5.5. So after you have secured the unit costs, we advise that the next thing that you get is the stock schedule, where we have the sales, we have production, we have the closing, We have the opening. So we draw the stock schedule. In the stock schedule, we have details here. In the details, we start with opening stock. Opening stock. You add production. You less sales. You less sales so that you get the closing stock. You get the closing stock. Now we have period 1, period 2, and period 3. Period 3. Sasa, we have the units. For period 1, the opening stock we are told is 0. Production we are told is 30,000. Sales we are told is 30,000. So that gives us a 0. The opening stock in the second period then must be 0 because the closing here is the opening here. The next one is production is 38,000. And sales need 27. So when you less, that gives you a closing of 11,000. And then here, the opening is 11,000. Production is 27,000. And then sales, they are 38,000. Therefore, the closing is 0. Although now in this question, there was no need of drawing the schedule because the examiner had already drawn for us. So from there now we are supposed to draw. The income statement. So let's design the income statement. So we are drawing variable costing. Income statement. Variable costing income statement. You can also call it contribution method. You can also call it direct. It has 4 names. It's called variable, it is called marginal, it is called contribution, it is called direct. So those names. So we have details here. Then we have period 1. Then we have period 2. Then we have period 3. So what we do is now to get the sales. We know that the selling price is what? The selling price is 9. So now to answer, tell me 9 times 30. If our figures are in thousands. If our figures are in thousands. If our figures are in thousands. Tell me 9 times 30 is how much? 270. So here we are not going to show the workings because the space is squeezed. The same case here, 9 times 27. 9 times 27, 243. 9 times 38. 9 times 38 is 342. Thank you, Bera. 342. Then you say less opening stock. Now the opening stock in the first period, it is 0. So 0 times 4.5, that is 0. In the second period, it is also 0. But in the third period, it is 11. So tell me 11 times 4.5. 11 times 4.5. Yes, there, you can see that's good. 11 times 4.5, 48.5. So 48.5. So we now bring production. Production, tutasema ni 30 times 4.5. 30 times 4.5 is the first one was 49.5. This one, 49.5. Okay. Haya, tusonge basi, unipatie kwa production. 30 times 4.5. That is 135. Alafu 38 times 4.5. 38 times 4.5 is 171. 27 times 4.5 . 121.5. 121.5. Haya, twende kwa closing stock. Closing stock in the first period is 0. In the second period, ndio ile iko na 49.5. And then the third period, it is 0. So with that, we have cost of sales. So this one is obviously 135. Tell me for the second period, it is how much? 171 minus 49.5. Tell me the figure. Oh, okay. It's also 121.5. Okay. Sorry, 121.5. Tell me now, commission. Oh, itarudi 171, eh? Itarudi 171. So with that now, we are able to come here and say that our gross profit, not gross profit, it is the gross contribution. Gross contribution. In the first case, 270 minus 135. It is 135. 243 minus 121.5. 121.5. And 342 minus 171 is 171. 171. Now kutoka hapo, you less the variable non-production. Let's see whether we have non-production. We don't have the, or let me write the format so that when you see it, so you say less variable non-production costs. Non-production costs. So in this question, we don't have the variable non-production. So when you less that, kama zingekuwa, you get a figure we say is called net contribution. Net contribution. A figure known as net contribution. So the net contribution is 135, 121.5, and 171. Then you say less fixed costs. In the fixed costs, we start with production. Now, production, the fixed ones, we are told that they were based on a production activity of 30,000. So it will be 30,000 times this one per unit. This one. So it will be 30 times 1. So here, unaiweka hapa 30. Alafu unaiweka hapa 30. Na unaiweka hapa 30. Then we bring non-production. Non-production, you can just take the figure there, or you can now come and tell us this non-production, it is going by the name administration. And we are told is 25. So the non-production is administration. Administration is always good to be as detailed as possible. So the administration is 25, 25, and 25. So with that, we are able now to come and get our figure, which is known as net profit. Our figure, which is known as net profit. So tell me in the first case, our net profit is how much? $80. It's the 6.5. And the last one is 115. 116. So you can double the rule. So that is how you do the what? Huyu anaitwa the variable costing. Variable costing. Let us now do the absorption costing. Let us do the absorption costing. Absorption costing. Now, absorption is also called total. It is also called indirect costing method, costing income statement. It is good to be familiar with those various names that are used there. So we have a column called details. We have another one called period 1. We have another one called period 2. We have another one called period 3. So, sales. 9 times 30, I think you had told me that was 270. 9 times 27, ulikuwa umenipea what? 243. 243. Na hii ingine ndio ulikuwa umenipea what? 342. Good. 342. So we now see less opening stock. Now the opening stock, as you can see, the first period is 0. Second also 0. But the third is 11. So now tell me 11 multiplied by 5.5. 11 you multiply by 5.5, you get 60.5. You get 60.5. Then we come to production. Now production is 30 times 5.5. 30 times 5.5 is what? 165. In the second period, is 209. In the third period, it's 148.5. 148.5. $148.5. I have closing stock. Closing stock in the first period it is 0. In the second period it is 60.5. The third period it is 0. Sasa, with that now, we can comfortably come and get our cost of sales. Cost of sales. So in the first case, our cost of sales is 165. In the second case, it will be how much? Is it is 148.5. Okay. 148.5. Sorry, I'm supposed to write them here. This is 165. This is 148.5. And the last one is what? Okay. The last one is what? $209. It's 209. So with 209, yeah. Let us get the figure that I told you is called gross profit. Gross profit. When you are in absorption, it's called gross profit. So 270 less 165 is what? 105. The next one is what? $94.5. And the last one is 133. Haya, kutoka hapo sasa tunaleta fixed production costs. Fixed production costs. In the fixed production costs, we bring the absorbed. Now the absorbed is 1 times the number of units produced, the OER times the number of units produced. So here when you multiply, this will be 30. Second period, we will have 38. Third period, we will have 27. Those are the absorbed. The OER multiplied by the units. Then you get the actual. Actual, it is the one that we charged in the marginal. You remember in the marginal, we charged 30,000 everywhere. So 30. So after you have done that, the figure that you get will either be an over or under absorption. And if it is over, it is positive. If it is under, it is negative. So hapa hakuna any difference. Here we have an over absorption of 8, so it's supposed to be added back. And here we have another absorption of 3. It's supposed to be subtracted. It's supposed to be subtracted. Under absorption. After you are done with the fixed production costs, you now bring the non-production costs. Non-production costs. And in these non-production costs, you begin with the variable. Now the variable ones, we know in this question they are 0. Lakini kama zingekuwa, you would have put them there. Then you bring the fixed. We know in this question, the fixed ones are administration. Administration. So the administration, we know it is 25 hapa, 25 hapa, and 25 here. So with that, we should now be comfortable or ready to get our net profits. So now tell me this one. Yeah, I can see 80. The next one. 77.5 and 105. 77.5. And then I'm told 105. So that is how you go about that. Then we have to do the reconciliation. So in drawing the reconciliation statement, I want to rub here so that I can draw my reconciliation statement. So reconciliation statement. I told you the reconciliation statement has 4 items. And if you are not very sure which one to add or left, you can be non-committal like this. You just tell us marginal profit. Marginal profit. Then you tell us difference in opening stock. Difference in opening stock. Then you say difference in closing stock. And then you get absorption profit. Absorption profit. So with that, we have period 1, we have period 2, and we have period 3. So if you're not very sure which one to add or to less, you're not very sure which one to add or less, you can just put them that way. And just put them that way. So in getting the absorption profit, this one I already have. This is 80, this is 77.5, this is 105. Those are the profits according to the absorption statements. Now tell me, according to Martino, the first period to pay a profit here, 80. The second period, the character, the 6.5. The next period, the character 116. So nataka sasa, you tell me the difference between these closing stocks or these opening stocks. In the first period, absorption wako na 0, marginal, angalia walikuwa na ngapi, niambie the difference. The difference in opening stocks of the first period is what? 0. In the second period, it is 0 also. In the third period, it is 11. Haya, tuende now kwa closing stocks. Closing stocks, the difference in the first period is 0. The second period, 11. And the last period, 0. You can even leave it that way. But because you have an idea that one of them should be added and the other one should be subtracted, you are guided here. Now this one you can see this one is going to be added and this one is going to be subtracted. So you just put this now in the brackets. And that's all. Very simple like that. So if the examiner had asked for reconciliation, although this examiner had not asked, you would have argued that way. Haya, hiyo tumemaliza. And I need now to proceed to the next question. The next question is summarize 4 assumptions of CVP analysis. The assumptions, I think I gave you 5 or so assumptions. I hope you still remember that the selling price remains constant. The variable cost per unit remains constant. The fixed costs total remains constant. The total cost can be clearly separated from like to fixed and variable. There are no limiting factors and so on. So I'm just mentioning as I clear my whiteboard because you already have those solutions. You already have them from the notes, and I believe that you are looking at them. So let us proceed to the next. Inasema Brickton Limited makes a single product branded P with a sales price of 100 and variable cost of 60, fixed cost 600. Assuming a taxation rate of 40%, determine the number of units to be sold to make a profit after tax of 200,000 per annum. So if they're asking you for the profit, you can see my screen is shaking. Let me change the right. So adjusted the writing. I hope you're still able to see me. Okay. So the first thing that you need to do is to come here and say that there's a formula I gave you. I think that is the formula I'm going to use direct. That profit made is contribution margin multiplied by the units minus F. You're able to see that? Okay. Don't know why the writing has changed. Kaanza kushake. So now, in this question, our F is the fixed cost, which we are told is 600,000. Then the variable costs, we do not know X. X is the one that we are looking for. The one that we are looking for. Now, contribution margin, we know is given as P minus V, the variable costs. So V will be equal to what we are already given, that is 60, plus the taxation. Tax is a variable cost because it is a unit. So if there is a tax of 40%, we are going to talk of 40% of 100. No. Sorry. That one will not be like that. That will not be like that. They are not charging per sales price. We will charge in terms of profit. In terms of profit. So let's first of all leave it that way. Then our P is 100. So the contribution margin is 100 minus 60. Now the profit after tax is 200,000. So profit after tax is 200,000. Therefore, profit before tax is how much? Remember, after you tax, we are taxing 40%. So what remains here is 60%. So before tax is 100%. So that when we tax 40 tunaachiwa hiyo. So tell me this one is how much? $120,000. Iko kidogo kuliko after. How you work out? You work. If after tumecharge 40 tunaachiwa 200. What was the original one? 333. Yeah, good. Can see that. 333, 333. So if that is true, then we will come here and say that now these 333, 333 should be equal to contribution margin of 60 multiplied by X, which you don't know, minus 600,000, the fixed cost. So from there, tell me what will be the number of units. $13,000. I see different values from yeah, so we are talking of 15,556. 15,556 units. So those will be the number of units that will be required. Now, as a result of increasing costs, variable cost is expected to rise to 65 per unit and fixed cost to 700. Assuming the selling price cannot be increased, determine the number of units required to maintain a profit of 200 per annum. You ignore inflation. So if you cannot change the, so after the changes, we still need to make our profit of 200,000. So after tumelipa tax, tutabakisha tu hii, 333. But our contribution now will not be 60, but it will be 100 minus 65. X multiplied by the number of units, because the variable cost has gone up. Then we minus the fixed cost, which has gone up also. Maybe tumeongezea watu mishahara, ama landlord ameongeza rent, ama differentiation imekuwa more and so on. So you raise the 700. So from there, Pambana, tell me the value of X, the new number of units. $29,524. Yeah, that's one of the reasons why of late you have seen many businesses struggling, even some closing, because when the costs have gone up, for you to remain where you are, you need almost to double. You see, this is almost double. So to double, that is not very easy. And because you are not able to double, then what happens is that these increases, they eat from your profits. And you find it is very, very difficult to survive. Good. Let's go to question 4B. I'm thinking we solved question 4B. Is that right? When we are dealing with the cash budget. Can you confirm whether it was solved in class or not? Do we solve? So did we solve? I can see Vera saying no. So let's prepare to solve it. So the question is on cash budget. Cash budget. So if it's on cash budget, we have details here. Then we are told to do for 3 months. We have April. We have May. And we do have June. Sasa, I told you we begin with the items of receipts here. The question says that you are in charge of making forecasts and preparing budgets for Condor Limited. You have been supplied with the following cost and revenue forecast and details of payments. We are given that direct material purchases, wages, production, overheads, admin, selling, sales. Now, cash balance is expected to be 90 on 1st of April. Period of credit allowed to by suppliers average is 2 months. Debentures worth 125 are expected to be issued in May, and the amount to be received the same month. So we can even begin with that. Look at debentures. That's an item of receipts. Debentures, we are told, worth 125 million is expected to be issued in May, and the amount to be received the same month. So because these figures are in thousands, our cash budget is in thousands. So debentures in May will be 125,000. Will be 125,000. A new machine will be installed. That is a payment that you think Apple. Sales commission, that is a payment. Dividend of 100 is payment. There is a delay in overhead, that's a payment. 20% of debtors pay cash. Okay, so now that is about sales or debtors. And we are told there is cash, who is 20%. We pay cash, receiving a cash discount of 4%. The 70% pay within 1 month and receive. So there are those who pay 70%. That is, we can call them credit. The sales on credit, 70%. And they get a discount of 2.5, or the remaining debtors pay within 2 months. So the remaining, another credit, it is 10%. So that we get to 100%. They pay within 2 months, they do not get a discount. So that's all about the sales. So if that is all about the sales and receipts, we comfortably come here and say that we have our total receipts. We will get our total receipts, which we shall designate as A. We shall designate as A. Tunaweza hata kwanza tumalizane na hiyo kabla ya kuteremka, ama to design so that in case there will be workings you have space. We come now to the payments. When we come to the payments, already to shall identify which are the payments. Tukianza hapo kwa information na what? Information 4, there is a machine. There is a machine. We are told it will be installed in March at a cost of 150 and the payment is expected in May. So hiyo tunasoma tukimalizana nayo hapa 150,000. Hiyo tumemaliza. The next one is sales commission 3%. Tafuta baadaye commission. Or we can even get it. Can get it. Commission, we are told 3% is payable after 1 month of sale. So when we are in April, we are paying commission for February, for March. And you can see March we sold 440,000. So tell me 3% of 440,000. Ngapi? 3% of 440,000. 13,200. Ndio tuweke hapa. Haya, then tuende kwa April 350. So 3% of 350,000. 10,500. And then 3% of 360,000 is 10,800. 10,800. So your commission tumemalizana. A dividend of 100 million to be paid in June. So there is dividend of 100 million. So 100,000. Then kutoka hapo, there is a delay in 1 month in payment of overheads and wages. So that means unachelewa na 1 month. Mishahara ya March unalipa April. So overheads and wages, payment of overheads and wages. So there is no mention of the discount, the depreciation, that's the one I was waiting for. So for the wages, tukiwa April tunalipa wages March 100,000. Wages za April 72,000 tunalipa next month. Wages za May 54,000. Then we have overheads. Now the overheads, we have production. It is also experiencing 1 month delay. there is administration, zaenda nazo zote, administration, and we have the ones of selling. So in March tuna delay na 1 month. Sasa tukuje hapa production wako March 40,000. Huyu mwingine 27,000. Na huyu mwingine ni 18,000. Then tukienda April we have 45,000, 24,000 and 13,000. Then we have 36,000, 25,000 and 11,000. Those are the overheads. Now from there, the next statement inasema 20% of debtors pay cash and they receive a discount of 4%. So let's deal with that. So if they are paying cash, they are paying that month. They are paying that month. So when we are in the month of what? The month of April. The month of April, sales are 350. So you get 20%, and then that 20% multiplied by 96%, 0.96. So that we get to know after the discount. So 350, 20% of that, then 96% because they have enjoyed a discount. So that is 67,200. Sasa hiyo tukuje tuandike hapa cash ya April 67,200. Let us do the same in May. 360 multiplied by 0.2 multiplied by 0.96. They are enjoying a discount. 69,120. 69,120. And then, the same thing with June. 69,120. Then kutoka hapo 70%. They also pay within 1 month. So they are paying within the same month. So if they are paying within the same month, it will be 350 times 0.7. But now they are enjoying a discount of 2.5. So it is 0.975. So tell me the first one. 350 times 70, 0.7 times 0.975. We are told, Sirao, they are saying, and 70% pay within 1 month. So within 1 month, in your month, not after. It's within 1 month. Hope you have gotten that. So if you have gotten, I can see Vera is talking of 238, 875. 238, 875. Okay, welcome. Now give me the second one. Give me the second one. Group 45, 700. 245, 700. And it's the same thing. 245, 700 in the other month. Then in the month of, rather the other percent, the other percent is 10%. They pay within 2 months. So nalipa the following month. So the sales of March, they were 440. So it is 440 times 10%. And these ones are not enjoying any discount. So how much is that? Yeah, 44,000. The same case will apply with May, 35,000. And that is 6,000. That is 6,000. So tumemalizana na additional information. Alafu sasa tukirudi huko juu kwa information 1, you can see information 2. We are told period of credit allowed by suppliers averages 2 months. So 2 months. So the suppliers, that is the materials. So when you are told the credit period is an average of 2 months, you are supposed to pay within the 2 months. So if you are supposed to pay within the 2 months, it means you are paying the following month. That's the meaning. If you pay within the credit period, you should pay the following month. But if you are paying in arrears, you pay the 3rd month. So here we take that they are paying within the credit period, and therefore the purchases of March, will be paid in April. So tukuja hapa kwa March, you can see there was 135. That is what we are paying there. Then there is 90,000 we pay here. Then there is 67,000 we pay here. So that we are paying within 2 months. I believe that we have captured everything. And if we have, let's now get this figure. Give me the total receipts here for April. Total receipts for April. Total receipts for April, 350,075. 350,075 shillings. So give me the total receipts for May. Total receipts for May. 474,820. 474,820. And then the other one. $350,820. 350,820. So with that, tuteremka hapa chini now, we get our total payments. Get our total payments. Total payments, which we are going to designate as B. Tuanze hapa April. Three that 3,200. 333,200. Tuende me. Oh, 4,500. 4,500. Let's go to June. Oh, 303,800. 303,800. So with that, we come now and get the balances. Getting the balances, we get the surplus or the deficit. And this one is always A minus B. You call it C. A minus B, you call it C. So 350 minus 3, that's 3. $16,800. Huh? I was expecting a 5 somewhere. These 350, 075 minus 3, that's 3,200. 160 or 16,875. 16,875. Tuende kwa hii ingine. Hii 474 minus 404. 7320. And then huyo mwingine 47020. Then we bring the opening balance. the opening balance, which is D. We call it D. We are told that as at 1st of April, we should have had 90 million. So 90,000 here. 90,000. So with that, I will have the closing balance. And the closing balance will be C plus D. So this one, I can clearly see it is 106,875. Here 106, we had hapa 106,875. Ongezea 70. But 177. $195. 177. 195. Then hapa 177, 195. You get to what? $224, $215. 224, 215. 224, 215. So that is how you do a cash budget. So question 5 is just theory. And sasa hiyo karatasi tumemaliza. We have like 20 minutes, so maybe we cannot start the next paper. So we call it a day at that point. Are we okay? We actually call it a day in that semester. We okay with that? Let me see, Sirao, Jemima, Leah, Vera, Reed. Yeah, Leah is okay. Sirao is saying yes, thank you so much. It's good. Okay. Yeah. Vera, we are okay, thank you. So welcome, thank you. Jemima, Lynn, we okay? Yes, thank you. Okay, good. So if we are okay, then I'm also very, very okay, very happy that you are okay. I just want to take this opportunity to, first of all, thank you so much for being our students at Destiny Technical Training Institute. We don't take it for granted that you chose us to be your trainer. We know the other institutions that you could have gone to, but you freely chose Destiny. Thank you so much. And we want to encourage you that come September 4th, you will still freely come to Destiny so that now we can do the advanced level. We have a very competent team there. We have Mr. Juma doing AFR. We have Mr. Wafura doing AFM. We have Mr. Wawero doing leadership. Then for specialization, if you want to specialize later on, we will be there. So we want to again take this opportunity to wish you the very best in your forthcoming exams. There are just few days that are remaining to the exam. And I want to say that no one, I'm insisting no one, even the so-called geniuses, has ever felt very comfortable when sitting for an exam. We always have some fear. We always think, na hii ni kama sijaelewa, na hii ni kama sijasoma, na ikikuja. So that fear is normal, but don't allow it to be too much that it disturbs you. Because when you allow it to be too much, you go to the exam, someone fearing, and when you go fearing, you already have failed that paper. But I would want to encourage yourself that now you are set. You have everything that is required, not only to pass the exam, but also even to get an award. My advice is usifanye swali lingine lenye hatujafanya pamoja. Mahali tumesimamia, stop there. Don't attempt any other question. If you have to do questions, do the ones that we have solved together. Because those are the ones you have the answer for, ukikwama unaangalia. But if you start attempting a question we have not solved together, you will not be very sure. Na ukikwama, utaanza kuingiza uoga. Na hiyo uoga, it can be very dangerous to you. So I want to encourage you that don't compute any other question that we have not computed. Compute the ones that we have solved together. For the theory, make sure you get time and answer the theory questions. If you are not able to get them in our notes, Google. These days we have Google, you people, you have internet, Google and make the short notes. Actually, you can set aside a whole day. You just revise the theory because the theory will be a big booster. Theory is always a big booster when it comes to computation papers. So I think the other thing that I wanted to say is that we continue to encourage you people to continue marketing us. Please talk to your colleagues who are not with us to come and join us. We have very effective programs. You can see our online is working well. We also have the physical classes. You are aware of that. That would be good. So market us out there and we will say a big thank you. So I'm going to send you a video, small video on how to prepare for the exams. You can choose, you can listen to it and pay attention to what is being said there, which will help you. And when you get to that channel, always ensure that you subscribe and you can share. And the other materials you can listen to, because I do not only teach the other things I do, I also do counseling psychology. So in case you also come across people who require counseling, you can refer them to me. Thank you. Thank you so much. Good day. God bless you. Great success in your exams.